All right, good afternoon, everyone, and thank you all for joining us. I'm Vernon Biggs, one of the institutional sales partners for Northern Trust Asset Management. And in this session, we're going to talk about liquidity, but specifically how liquidity is being impacted for institutional investors. We're also going to give some of our broader observations for what we're seeing in the short duration fixed income market. Today, I'm joined by Peter Yee. Peter is our head of short-term portfolio management in the fixed income space and also the head of credit research for Northern Trust Asset Management. Peter oversees over $330 billion in short duration assets. We definitely want to hear from you all, so please use the session chat at the side to ask any questions that you might have. We want this to be interactive, and we're going to get to as many questions as we can today. Let's jump in. Peter, how you doing this morning?
I'm good. How are you doing, Vernon?
Yeah, things
Thanks
are well.
everyone for having me.
Absolutely. So one of the asset classes that we've seen a significant amount of inflows in this year, I was hoping you could talk a little bit about that in the fixed income space, and then ultimately, how institutional investors are reacting to this.
Yeah, absolutely. So for the first half of the year, looking at data from the Investment Company Institute, the money market industry really underwent just incredible growth. From its peak at the end of May, industry assets grew up to 4.8 trillion, which is roughly about 30% higher year to date. That actually equates to about $1.1 trillion in inflows. That's just a staggering amount. In putting that into perspective, that amounts to almost the size of the 16th largest world economy between Indonesia and the Netherlands. And about 950 billion of those inflows were institutional. So the COVID pandemic certainly introduced significant uncertainty, and uncertainty has a very corrosive effect on the markets. But when you break down what was actually happening, it does tend to make sense. As the pandemic started to unfold, risk markets just underwent significant volatility. Were doing all that they could to harvest their liquidity. Investors are very aware that liquidity is the lifeblood of any organization. So companies expressed an enormous desire just to build a safety net to safeguard against their operations. Some sectors of the economy immediately underwent huge impacts to their demand, obviously from the coronavirus, and essentially, they had to prioritize and focus on liquidity. So they drew down a lot of bank credit lines, and then, opportunistically, they tapped the bond markets at these very low rates. Those same companies that could tap the bond markets, they did so in just record amounts. Today, we're already exceeding 1.5 trillion in investment grade new issue supply, which is clearly a record amount. And that's well over the total amount from last year already. And we surpassed that level early in June. But, since the money market assets hit its peak in May, we're now starting to kind of see a little slow leak in liquidity assets, which is, again, not all that surprising. A lot of this cash on the sidelines from institutions has either, it's been committed to smoothing operations or even redeployed as fuel into other risk asset classes. We also know, federal stimulus funds, which were initially placed in the money markets, again, those have slowly been redistributed across the economy. But even after the Fed cut rates to essentially zero, industry assets are still up around 800 billion this year. And it ends up being, really simple. Investors just continue to view cash as a very expensive yet necessary insurance policy.
Yeah, you mentioned some great points. If you think about COVID, the uncertainty from COVID has led to a lot of these corporations hoarding liquidity, really tapping the bond market and moving into some of these very conservative asset classes, like you mentioned, so cash. And as we know, one of the biggest factors that affects cash is interest rates. So Northern Trust recently published their 5-year outlook, their capital market assumptions. Could you talk to us a little bit about your views on long-term interest rates, what you're seeing in the market there, and ultimately how that is impacting institutional investors looking for liquidity?
Yeah, no, great question. Well, the rates market, it continues to reflect just significant weakness, going forward. And we know, it'll take years for some industries to rebuild themselves, and many could, be completely transformed or even less relevant. And like I mentioned earlier, companies are prioritizing stability over profitability. We've consistently expressed our view that, the Federal Reserve will, keep its policy rate here at 0 for at least the next 5 years. And we're even biased for it to be longer. Inflation, it's going to continue to be a key economic indicator, with the impacts of accelerated technology gains and, again, the weak demand outlook. It's really hard for us to find the catalyst for inflation to be consistently at or above the Fed's 2% target. And we know from, recent Fed guidance that, they're even willing to allow for a period where inflation could run above its 2% target as, really an offset to the many years it's been consistently below that 2%. And globally, central banks, they're going to do what they can to keep monetary policy accommodative with their massive monetary toolkits. So, we're expecting just another prolonged period where liquidity and cash expectations will be for a return of principal rather than a return on principal. And frankly, it would not surprise us if the Fed waits and delays raising rates even well beyond the next 5 years.
Yeah, and I know Northern Trust has been in that camp of lower for longer for a long, time now. So, if we're thinking going forward, specifically with rates, this is a question that I get from a lot of our institutional clients. Is thinking around, could rates potentially go negative? Is that something that you think could happen? Is that even a big concern for U.S. rates going negative?
Yeah, so we have a pretty strong conviction around, our base case is the Fed doesn't take its policy rate negative, just given the ineffectiveness that approach played out in Europe and in Japan. But, it's certainly possible that the market takes rates negative on things like, short treasury bills as an example. But even that, a lot of that concern has been alleviated lately just because of the huge mountain of financing the government requires to fund the various stimulus bills associated with coronavirus. But it is a little bit baffling on why there's so much attention surrounding the possibility of the Fed to take its policy rate negative. The large majority of the FOMC members have just repeatedly expressed the view that negative interest rates are just something they're not, looking to implement right now. And even earlier in congressional testimony, Chairman Powell pushed back pretty clearly that, they're not going to take rates negative. I just think some of the consequences that the Fed would encounter, just from, the operational complexities of, transacting at negative yields for things like money market funds and bank deposit rates. I think it would ultimately just create enough disruption that, it could potentially even destabilize the financial system. So looking at it through that lens, the risks just simply, outweigh the unproven benefits at this point.
Gotcha. One thing that it's always, I feel, important for investors to be able to do is to draw some parallels between, this most recent pandemic, this recession, the downturn that we're seeing, and then also the the crisis that's probably the sharpest in many investors' minds, which is the great financial crisis of 2008. I know there's a lot of similarities and differences. Could you elaborate on that a little bit for us and tell us your thoughts on that space?
Yeah, Vernon, that's a great question. So, we often look to the 2008 financial crisis playbook to, see if we can identify any parallels to leverage in this crisis today. And I guess what comes to mind as the biggest difference is that, today the largest financial institutions and, frankly, the financial system itself, it's been structured much better, at least to withstand the most severely adverse economic scenarios. And, without a doubt, the aggressive makeover initiated by regulators post 2008, it certainly helped us prepare for, this current pandemic. Banks will, certainly undergo some stress, but, I don't think anyone is expecting the banking system to be brought down to its knees like it did following the great financial crisis. But, one dynamic I would say that is already starting to repeat itself is, this global search for yield. When the yield on liquidity is pegged at zero, and even could be viewed as an asset class with a negative real return, investors just have a natural tendency to look for a better balance between risk and reward. Investors are just simply not excited when they see, a 10-year treasury, yielding well below 1%, trading around 65 basis points as we speak. In this environment, and we think there's going to be increased demand for things like high quality short duration products that will have a much better risk reward profile than something like a money market fund. Immediately following the great financial crisis in 2008, we did find ourselves, or we are finding ourselves in a much similar environment today. We found opportunities back then for innovation in a context of a zero interest rate environment. Northern Trust and FlexShares, we actually launched an ETF with the ticker RAVI, which stands for Ready Access Variable Income, that really has a very short duration mandate, but offers a unique liquidity characteristic through an ETF structure. And more importantly, this product provides a much better risk reward with a total return investment grade strategy. This was a product that resonated with investors back then. And, we're expecting it to gain even more traction as investors once again, have this search for yield in a global marketplace where all developed central banks are stuck with policy rates at zero or even negative.
Yeah, I think you touched on a lot of points. Some of the differences, the capitalization, the strength of the banks, 2008 to now, much different. Banks are much stronger, better, well capitalized. But, some of the things that I feel like are really unique that's interesting is the evolution and development of that bridge asset class that you mentioned. So other products like Ravi that fall into them, having something that is a little further out on the risk spectrum than just a money market fund, but not quite as risky as something like an ultra short bond strategy that are letting investors to meet that yield objective that they have while still trying to match that risk tolerance.
Yeah.
Ravi plays in that cash or kind of like cash equivalent type of space or like money plus space. And I know Northern Trust has very specific ways of thinking about preservation liquidity, investing liquidity, or more broadly, our cash segmentation strategy. Can you talk a little bit about that and give investors out there some insight as far as how they should think about cash segmentation and deploy those funds across some of their portfolio management strategies?
Yeah. So, as investors get more comfortable with this lower for longer mindset, To your point, one interesting framework that has, again, resonated with investors has been, thinking about a cash segmentation strategy. Let's not forget that cash management also plays just a critical role in an asset allocation, not just for liquidity. As a risk-controlled asset class, cash provides stability when other asset classes may be undergoing volatility. But it also allows investors to be opportunistic in the marketplace. And so, that concept, we also want to make sure we take advantage of. And in a cash segmentation strategy, clients have the opportunity to customize and segment their cash into really three distinct buckets that, have different risk, return, and liquidity expectations. And so the three buckets are operational cash, reserve cash, and strategic cash. Operational cash is used just for immediate or short-term spending needs, using the most conservative government money market funds as an example to sweep the everyday cash. Reserve cash is for intermediate spending needs and gives some flexibility for a better balance between a high quality portfolio and return expectations with some minimal principal fluctuation, but we'll likely have some exposure to credit. And then finally, strategic cash is for longer term needs that can have generally a 3 to 6 month time horizon. Strategies like ultra short fixed income tend to meet that strategic segment, utilizing durations of 6 months to a year. But as we do these segmentations overall, your blended portfolio will have a much more compelling risk reward balance. And we think that's something that a lot of investors have considered and should consider going into this new low interest rate environment.
Got it. Well, Peter, let's switch gears here and have a little fun. I'm sure you were up late last night, like me, watching this presidential debate. In a word, entertaining. But I know we're getting a lot of interest, and this is even prior to once we knew which candidate was going to be the Democratic candidate. But a lot of investors want to know, leading up to the election, post-election, how is this going to affect the fixed income markets? And I don't know if you have any early indications from just looking from yesterday to now and feedback and things like that. But I know we're getting a lot of interest and questions around that. So if you could elaborate and give us your thoughts in that space.
Sure. Well, the presidential debate last night was a little hard to watch at times, but you can really feel some of the disdain for each other. But if this is a preview of what's to come in the next debates, as well as the elections, there's going to be a lot to analyze. And without a doubt, the elections present just another layer of uncertainty for investors. And the consequences will, ultimately vary sector by sector. But I think investors will be clearly watching not just, the presidential outcome, but, the possibility of, scenarios like a Democratic sweep where, the Democrats also take, the Senate as well as the White House. In that scenario, I think we would expect more dramatic implications, ranging from, higher taxes, greater banking regulations to, sectors like healthcare and energy that will be subject to major changes in this scenario. And like I mentioned before, the bond market is still forecasting weakness and uncertainty. Even after the elections, frankly, there's no guarantee it'll end there. There's an emerging risk that there could be a delay in declaring who the winner will be in the White House. And that uncertainty can extend beyond November and could even prompt, other, social unrest if we don't have some more clarity soon. So for all these reasons, we expect rates to remain incredibly low with, some potential for, some modestly steeper yield curve if Trump wins, and, possibly a slightly flatter yield curve if Biden wins.
Got it. Well, we have about 3 minutes here, so I'm going to take a couple questions. So let me read this one off here. So, in reference to retail investors, there's some insight as far as this audience member wants to know. What are some trends that you're seeing in the retail space as opposed to the institutional space that we focused on for retail investors who are trying to manage liquidity in this particular environment?
Sure. So while the bulk of the increase in money market assets had been, really institutional, retail balances also had a spike during the year as well, but, slowly redeployed as, various parts of the economy started opening up again, like in entertainment, travel, and restaurant dining. So what we observed was, simply a pause in discretionary spending because of the shutdowns. And while we're all socially distancing, all that pent up demand prompted, an eagerness to spend once the shutdowns were lifted. Retail investors were essentially forced to save during that isolation period because their normal routines were just severely disrupted. The general sentiment here is, now they're still looking for a little stability when all the other markets looked incredibly volatile. So, some of that saved liquidity is still being, used for for in case things do start to get even more challenging, and just in case there is, a resurgence of, issues that, come from the coronavirus. So, retail investors, they also are looking to, just stabilize their balance sheets, but, a lot of that pent up demand that they had earlier in the year is really starting to get spent and deployed within the economy. So that's actually a good sign.
Got it. Okay. We'll keep the questions rolling here. So another question we had come in: what strategies for managing liquidity do you see institutional investors using and starting to leverage?
Well, I think, again, a lot of institutional investors, as they think about, cash and liquidity being a really expensive insurance policy for that stability, it's earning zero. And again, from a real yield perspective, it's, negative if you consider inflation. And so, institutional investors are really gravitating towards, how can they optimize their cash allocations? And again, one of the things that they're really starting to adopt is, cash segmentation strategies. And as the economy heals itself, as the financial system heals itself, and as the various sectors, again, start to rebuild, we're expecting a very prolonged period of near zero rates here. As that all comes into consideration, we think investors will ultimately start to think more about cash segmentation strategies and use that to just optimize a better risk reward.
Excellent. Well, Peter, again, thank you so much for your time, for your insight and expertise in this space. I'm sure a lot of our audience members had an opportunity to get a couple sound bites and some things to take away. Everyone, again, thank you so much for joining. Please don't forget to visit the FlexShares Expo booth. You can find that if you click the Expo link on the side. And you can go and reach out to any FlexShares member. We'd be happy to interact with you. I know there's a few more questions that we're going to get to, so feel free to continue to pour those in. And at this time, since we're concluding this session, you can all head back to the main stage for the next session, which is the Alpha of Inclusion. Thanks so much for joining.